We got a
I gotta get you the invite. Thank
Oh,
you.
thank you, yeah.
Thanks for the reminder.
I don't think you're on.
test. Is mine working? It sounds good.
Test. Mine working? Great.
Test. Is mine working?
Hello.
Hello? I guess that's working.
Marco.
They're having a panel. Yeah, there is a panel.
My son's got me into Marco Polo. They taught him that game at school. And now it's
Hello? Hello?
Hello.
Hello?
I think I'm on. That's great.
I was a little slow today. I was like, oh, gee.
Slow, getting up.
No, like I was helping around the house. What?
Did you do pancakes?
No, we did scrambled eggs and toast.
I was fishing last night, so
How was
I,
that?
yeah, well, yesterday in the afternoon. So I was like, I gotta wake up early and read, and read this.
Yeah, I read this.
Testing. On.
I'm thinking of me. This is like a very big. I mean, if the memorial service wasn't
A lot more family would be here.
Test, test.
All right, man. Thanks for coming.
Can you hear me?
Yeah.
You can hear me?
Hey, good. How's it going? Thank you.
All right, let's sit. Let's have a seat. Let's sit. Let's sit. Let's sit. Justin. All right. Devin, are we live? Are we live? We're on YouTube? All right, YouTube stars. All right, this is a big moment. All right, thank you for everyone who's coming today and anyone who's online. Welcome to our 2025 Investor Day for B&D Holdings. As I just mentioned, we have people visiting online on YouTube, so that's pretty fancy for us, which is cool, and we're very excited about it. For anyone on YouTube, just a quick note, if you have questions, comments, please type it in the comment sections on YouTube. We have people tracking, and we will interrupt appropriately to ask questions. We will have a Q&A at the end, and we will have a slight Q&A on the panel. So there will be moments to ask questions, but don't hesitate to interrupt us or add comments at any point in time. So that's what we like to do, chat with our investors. So we appreciate it. All right. We're excited to chat today. We're going to talk about a little bit about our platform growth, B&D, a little bit about our history, a lot about returns and performance of our funds. Obviously, you're all investors, so how are we doing with those investments? And then, what's going on in the market, right? Obviously, it's an interesting time in the world, so how is that affecting our investments? For now, all is well, but we'll see how it goes. I'm going to run you through the agenda really quickly. We'll go through strategy. We're going to talk a lot about tenants and our tenant-centric mindset. We were a tenant, so we continue to have a lot of focus on our tenants. We'll go into our development highlights. We have an exciting panel, Bill Pruding from JLL and Justin Horowitz from Cooper Horowitz, which I think will add some nice flavor to today. You don't have to listen to Martin and I too much, and Danny. We're going to talk about BD Capital. I'm excited our CEO of the lending arm is going to give us a little highlight of our lending arm, which is growing and really doing well. And then we'll get into some of our fund strategy and performance and some individual investment highlights and performance. First, I'm going to introduce Martin Siegel, who you all know, our fearless leader, founder, and CEO. Martin, I'm going to go a little history. He attended Indiana University. He grew up in the family business, and then after the business was sold, he worked in private equity, helping buy additional businesses. So he has a great investment background, operational background as a user of real estate, and then business background buying other businesses. He then launched the family office, and really through Martin's vision.
Rob, I think my father launched it.
Okay, Martin's father launched the family office. Martin helped take over the family office or lead or grow the family office. Thank you for clarifying. And now really a lot of Martin's entrepreneurship through Barry and through the whole B&D culture and his vision has grown us to where we are today. So we have a national industrial portfolio. We also have a very large lending arm. And a lot of that is due to Martin's vision and energy. So he's also a joy to work with and has a great mind for risk. So we're all lucky to have him. So Martin, there we go. Thank you.
Thank you, Rob. Thank you all for coming out. Good to see you on our second annual Investor Day. As many of y'all know, my father passed 2 weeks ago, and he was a mentor and an inspiration for me. We started off he started a roofing supply company, Bradco, in 1966. We sold it in 2007. I stayed on, and he decided to give all of his wealth, for the most part, to foundations. He did give the family in the 80s little pieces of the business that grew, and he really became my father's so biased, a great philanthropist. Given in Africa, Central America, and in the U.S. And he worked until maybe like a little over a month ago on Friday, and then by Monday he was deteriorating and couldn't come in anymore. And once he knew he wouldn't be able to work anymore, things went downhill. So it was a tough couple weeks. We miss him in the office. He's an inspiration. He taught me to get started in real estate. I worked for him in high school, and even before that, a lot of what he talked about was business growing up. We'd visit branches, and then he'd tell me, you know, you always want to own your own real estate because, you know, we'll buy a building, you know, for $2 million. We'll open a Bradco location. We'll rent it for $200,000 a year, triple net. And, you know, if you put that on it at 6%, you know, this is going back a while, you know, your return on equity is X. I was like, I have to do more of that, you know. So he gave me the opportunity to buy real estate, our own locations, you know, 20 years ago, probably, maybe longer. And that's what kind of started me in industrial and outside storage. We use industrial buildings with outside storage. And I bought my first building a year or two out of college, 1031 into a bigger building. And then I said, you know, I realized, well, maybe I can get my brothers and sisters when we started having a little bit of liquidity, and then I knew he would let us buy more buildings. You know, he might have not let me just buy them. So I got together and we started cross court with my brothers and sisters, and he let us, we were opening so many new locations. We bought 4 or 5 buildings. And that was kind of my intro to the real estate world. And that cross court became our friends and family fun series of down the line. My father was a big tennis player, so we used to use tennis acronyms for our LLCs until we ran out of tennis acronyms. So that's really what, you know, got us started. You know, with all this going on, I didn't prepare too much for today, but the good thing is I like to be in relatively simple businesses and relatively simple investments and do them well. And we've been doing it for a long time. So the good news or the bad news is, you know, not too much changes, which is kind of what we want. We just want to get better at what we're doing. You know, on top of the background, you know, each of his foundations are not just giving away money. I consider them, Single Family is very well respected in Africa. It's best in class. Focus Central America is getting there. It really started a culture in the office of working together and really having an entrepreneurial culture where everyone's sharing ideas and excited to work and do good work, but also have fun. So, you know, we miss Dad, and you know, and he was a major mentor for me. So what we're becoming is, or maybe we're there, we're in a fragmented space, which is shallow bay industrial and outside storage. This is a very typical building for us, 35,000 square feet in Del Rey, lots of shingles in the yard. And when we started buying these, not many people were buying them. Now, a lot of large institutions want access to this space, and we've kind of developed a team over the last 5 to 10 years to focus on these assets. It's kind of happened organically. And what I'm very happy about now is our team is about 30 people. And we got full service leasing, property management, construction, acquisitions, and we all work together to create value and identify opportunities in this space. And when you look at our track record, which, you know, I didn't understand the value of a track record, you know, initially, you know, but now that we've had a lot of exits, you know, I've come to realize that this is a tricky business, and the track record kind of is just flat out says your level of experience. We deal with tons of problems every day on a lot of deals, before acquisitions, during acquisitions, and our track record lets us look back and say, wow, we've kind of accomplished a lot, and we can deal with a lot of different things. You know, we can execute on acquisitions, leasing, construction, and dispositions at the right time, and refinances. There's kind of a lot going on, and we have to work together to kind of become best in class in the shallow bay and iOS space. And I think we're getting there, and I think we have the right team. And our track record shows that, and hopefully we can keep adding on to that. What separates, there's a lot of smaller shops starting up in shallow bay, which warehouses less than 100,000 square feet, and outside storage. Outside storage is probably one of the hottest areas in real estate, in industrial real estate, and it had some of the highest returns the last 10 years. When I first started, we would buy the building and say you get the land for free. That's totally changed now. You know, they're charging a lot for it. And we work with a lot of the same tenants. And this has a lot of advantages. It creates opportunities for us in the market that our competitors don't see. We can buy properties from our tenants. We can lease them buildings before we close on them. You know, the heads of real estate call us and say, hey, what's the market rent in Tampa, you know, for this kind of building? Do you have anything? We trade information. You know, we're looking at an opportunity where they're looking for something. We call them, and what do you think of this building? It just creates a lot of knowledge for us and opportunities, and de-risks our acquisitions and existing portfolio. And in outside storage, there's not that much market information. It's not perfect, you know, it's this much an acre, that much an acre. So have real-time tenant information, trading back and forth, along with leasing within our portfolio is a big advantage. You know, as we're getting bigger, when we first started, it was me in a room buying some deals, then it was me and Danny, and then it was like me, Danny, and Justin, and you know, and now we're, you know, we're 30 people, and you know, unfortunately, like I can't be involved in buying deals anymore. It's just like not reasonable. And our space focuses on smaller buildings and outside storage. It's an operationally intensive business. It's more expensive, and you have to operate well. So I spend a lot of my time focusing on creating the best team with Rob, Danny, Noel, and everyone else, and the best systems in place, and really coming up with the best culture. We want to have, we have with our team members, we want to have an open, trusting workplace environment so that acquisitions knows what leasing's doing, knows what construction's doing. We're trying to do high volume, and all this information we kind of want to use together. So Ray Dalio in his book Principles, you know, has talked about, you know, as you're building a firm, you got to just really focus more on the machine than, you know, any individual thing. And I didn't realize that, but as we're getting bigger, a lot of my time and our focus is what are the best systems, what are the ways we can engage the most people. Because what we want to avoid, we want transparency within the firm, we want entrepreneurship, we don't want to lose that. You know, we don't want to make mistakes that are preventable. And at the same time, we want to execute on opportunities the market might not see. And how does that, you know, we're doing 2-3 leases in one market in Norfolk. Rebecca, who does acquisitions, knows what's going on. She's like, well, I might as well just call in every other building that looks like that and get it at a good basis. So we're kind of, you know, using our knowledge to approach the market differently. In the space that we chose to be in, we really want to be best in class over time and put together the best in class team and get people that can really elevate throughout their careers. And I think we're doing that. We can always do better, but we want to scale in the space. And you know, one of the things we do is, you know, going back to my father, he had this thing where he would sit around at Bradco and he'd bring in like 5 people, 7 people, talk about an idea, and then we'd rate it like 1 to 10. You know, everyone, no matter what even if you weren't, even if you were like the secretary, you know, and it was, and you know, he'd read out the numbers to everyone. So we kind of adopted that, you know, from our foundation with a lot of our decision making, you know, investment committee. You know, I was on the team's call yesterday. Everybody rates the deal. We do 1 to 5. I don't know why. We changed it to 1 to 10 in his honor. But you know, construction does, and you know, and it just helps. You know, not everyone wants to speak up in a meeting, but hey, if construction's a 2, we want to know why. Or you know, leasing is a 1. What's happening there? We're looking for functional buildings, and we want to be open, transparent. We want to keep growing. You know, our background is, you know, we come from the roofing supply. We're an operator. That separates us. We also invest a lot of our own capital, a lot of family, myself included, and I don't do it because I have to. I used to be an LP investor, and of the universe of investments that I see, and I see a lot, I actually like ours the best. I understand them, they're fairly simple, and I feel we can execute on them. I am selling my book, but I would still rather invest in my deals than anyone else, and frankly, they've done better. Anything could change, but we're trying to build our firm for, you know, good markets, bad markets, and all that. So yeah, we've been in this space for a long time. Coming from a tenant, we know how to work with tenants, and we see the value there. We want to, you know, and we want to keep growing. Over time, and this, you know, we've become a full-service real estate company, which you have to be in our space doing smaller deals. maybe now the deal size is kicking up, but they're still relatively small. We're not buying, $50, $100 million single assets, although we have done large deals. The fees are not that significant given the amount of work. It's a higher operationally intensive business. So we've made the investment in every part of a real estate business that you need to have. And what I'm seeing with some of the upstart competitors that are in the space, they're hitting a point, they have 20, 30 buildings, and then it becomes, I can do a recapitalization, but then I have to add a CFO, I gotta add a construction, you're adding millions of dollars in costs. I feel like we're already there, and we're at the point that now we can do more volume and kind of scale through the infrastructure we built. We can use technology to get better. We brought property management in-house. We don't do too many multi-unit industrial assets. Where we were using an outside property manager. The truth is, we have, when we're working with our institutional partners, we have to know every aspect of those buildings too. So accounting basically follows the accounting of the property manager. We're following up with the tenants. Any problem comes up that's major, we're doing the work anyway. So we just brought that in-house to make it seamless for us and kind of allow us to bring in more fee income so we can build out our team, bring us closer to tenants and really control the construction and every part of the investor and tenant experience. And we'll keep doing that with different segments over time. Yeah, so our real estate portfolio is about, we're valuing at about $1.1 billion. I guess assets under management, 9 million square feet nationally, 230 properties in 37 states. People say, how can you, manage that? And we have a great team. But on top of that, we do a lot of single tenant, long-term lease buildings. So we do a fair amount of value add. And a lot of the industrial tenants, especially with yard space, grade level buildings, they self-maintain. They don't really want to call the landlord if there's a plumbing issue or something like that. They're equipped to fix it. And we think we have the right pieces in place that we can scale pretty quickly. I would like to do maybe a couple larger portfolios or just one larger portfolio. With our infrastructure, I think we could grow our assets to 1.5, and then by adding incremental people, $2 billion. And I see a lot of value in a little, and that's as long as we can generate investment opportunities that make sense. And I think we can. There's a lot of value in scale. We're always moving tenants from one building to another, bringing on new tenant relationships, just bringing on new broker relationships. So, and I think the institutional market realizes that once you get big enough, things just happen that usually are good, we underwrite a building, the tenant's gonna execute their leases for the next 15 years, and a year and a half in, they forget to execute their option, When you have enough building, that seems to happen 2-3 times a year. Maybe they'll get smarter, Or, you buy a building and then a year, 2 months later, industrial, and we're usually in dense infill areas, not maybe super infill place you want to be. It's still one of the lower value uses of real estate. So apartment developer calls you, a retail developer, and all of a sudden you have an unplanned exit. That was in the back of your mind. Yeah, it seems like, we've grown a lot, but it's been pretty steady, and that's as we're adding talented team members, we get better at certain things, we build tenant relationships. We're seeing more opportunities that we're excited about, and we're executing on them. You'll see a lot of growth from 2020 to 2021, and there are other sides that indicate this. One of the things, since my father gave away all his money, which was great, at some point I did realize, that's kind of like when Rob came on, we're gonna have to raise institutional capital or outside capital if we're gonna grow the platform that, like we want to, or like I want to. It's not that I want to just grow, I just see the opportunity kind of in the space. So you'll see our growth is kind of in line with when we started bringing on capital partners and becoming more sophisticated. And we hope to continue to grow the acquisitions, maybe continue on the one-off stuff we're doing, and maybe pick up a portfolio or not, as I'm talking to other players in the space, and they're kind of hitting a point where they want to sell and realize their carry and kind of go again, as opposed to just growing. So, 2024-25, we did 25 acquisitions, $345 million in total cost, 3 million square feet. This probably doesn't include Fritos that we built. I won't give the exact numbers, Danny has them, but while this is going on, I know our history of Frito, we've done about 19 build-to-suit acquisitions. Build-to-suit, building these from the ground up. Dispositions were one-off selling properties. I had a fair amount of retail properties and mixed-use properties in New Jersey. I love retail, but it's kind of a distraction to the firm. Nobody can underwrite them anymore because everyone's industrially focused. That means I have to do all the work and Danny. So we just strategically sold them, so we could focus on what we do best. And that was a lot of our dispositions. I don't think this includes the Fritos. I know we sold over 50 million of Frito-Lays that we built from the ground up this year. We also did a recapitalization that I'm very happy with. We closed in April. We returned all our initial investors' money, and we still own the asset, and we completely rolled into our profit into the new deal. We're really excited about it. But it just shows our continuing ability to execute on a business plan and execute on an investment for our investors. And that's not included in the disposition number for this year. This is what we're all kind of here for, returns, and this is kind of a summary of our realized returns. So we've invested $58 million on properties that were realized and distributed $131 million in capital. We've obviously invested a lot more than that over the years, and have done, on our old investments have done very well. When I first started, it was with family capital, and a lot of our investments were buy and hold forever, and we still have a lot of that, and we have a fair amount in progress. Yeah, 67% realized IRR, 2.25 realized equity multiple. We'd like to keep those numbers going, obviously, but a lot of these were bought when iOS wasn't a thing. Can you keep a 67% realized IRR going forever? No, but but we try to do very well and beat the market, and we think we're in a good space, and we have the expertise I know we have the expertise to do that. This doesn't include our foundation assets. That was like another 50 million of sales. That we don't put debt on those assets due to UBTI and different foundation rules, but we hit a 17% unlevered IRR on those, and properties that we bought and sold. So, talk about our investment strategy. I'm not going to go too much into it because we got Bill and Justin investment strategy. Yeah, investment strategy to talk more about the market. So some will talk about the market, but I'll go a little into it. One thing with dispositions, one reason I like these smaller industrial assets, especially less than 40,000 square feet, is users like these these are in high demand by end users. So we always underwrite that we're going to lease it for a higher price, and that's how we're going to realize our value on an exit. But we also look at selling it to a user who's coming in and paying above market. It just gives you another exit point that certain kinds of industrial real estate don't have. Like a building like this is like kind of our perfect building. It's a building we bought in Irving a long time ago. It's very functional for a tenant. The looks don't matter as much as the excess yard, the docks, the grade level loading. And so when we up the lease, when we increase the lease rate again in like 2030 when it comes due, I wouldn't be surprised if we also market it for sale, just because there are users that pay a lot more, and we're seeing that more and more, especially for smaller buildings. I prefer single tenant buildings when we can. The reason you can push the rents more and they're in higher demand is even if there's not a ton of yard space, if you're in a multi-tenant building, you're kind of limited in what you can store outside. A building like this, a user can come in, a tenant, and they can just, when they're busy, they just add more stuff outside, even if they don't need outside storage. You go to some small 12,000 square foot buildings with a little bit of yard, and you'll just see stuff everywhere. And that's the company, outgrowing the space. And now people are paying more for that, and I think they're going to continue to. So our two main strategies that we like to stay within are generating cash flowing deals. These typically have a higher cash on cash return for investors and a lower IRR. A lot of times which is a total return. A lot of times we'll identify a building for a tenant before we purchase it, we'll sign a lease, and they'll move in. And that totally de-risks the execution risk. There's always risk, but in today's market where it's a little harder to get higher leverage, interest rates are higher, properties are cash flow constrained from a lending perspective, you might only get 55 to 60% a loan on the property. So returns are a little lower, but it is a little safer. I like them because they're long-term leases, and the annual rent escalations are 3 to 4.5% sometimes. So over time, it's a nice return. A lot of our institutional partners like a little higher total return by buying something with a low rent, fixing it, and raising the rent within 2 to 5 years. I like doing both. There's a lot of opportunity out there. Industrial rents are up tremendously the last couple of years, and leases in industrial are on 5 to 15-year leases. So you're buying a building with a cheap lease, and we have the ability to, when that lease comes due, either re-tenant it or increase the rent, or sometimes increase the rent before the lease comes due, as the tenant wants the security of a place for the long term. With our value add, we're buying buildings below replacement cost and below market. On top of the returns being good, if the market changes, you should still be at a good basis. So I feel you're very protected. And that's why I like that strategy. But they say yield is temporary, basis is forever. And I like to get a good basis. So we have great tenant relationships, something we've been talking about a lot, and it drives a lot of our activities. We know where tenants want to be and what'll happen, and they'll talk about a deal we did in Ardsley, New York. A tenant wants to be in a building it's in Westchester. It was a roofing supply tenant. We found them a building, and it was maybe 100,000 square feet. They were going to take 40. And the rent was just too high for them. That's what happens once you get over $1 million a year for a location. And we walked through the building, and JM said, "What are you guys doing?" The GM was occupying the space, and we're like, "Well, we're going to rent it. We're buying the building, and we're going to use this." And they're like, "Well, no, we can't leave." So we ended up re-upping the lease with GM at the same terms without doing any work. But we wouldn't have found that opportunity, which was kind of totally off market, if we weren't looking for the tenant. And that kind of happens over and over again. We have a great in our speculative investment. We have a very good reputation for executing. A lot of brokers know us, want to bring us deals. They know we're going to transact over and over again. And sometimes we're their first look. They kind of spread it out. But all these different activities, looking for tenants, working in the market creates opportunities. And doing both, working with tenants and looking for speculative. If the market changes one way or the other, capital markets slowed down maybe 2 years ago, but one of our tenants brought us 5 opportunities to purchase the buildings and put them in long-term leases. When other people were slow, we were still executing. So we like that ability to kind of go back and forth and switch between strategies. As long as you're buying a functional building. So I kind of talked about, we look for a good basis. We're always buying things that in areas that we like, as far as we can tell. We're not really going out to tertiary markets, not that we wouldn't. We like to chase the beds and the population growth. We build these industrial buildings. To build them maybe costs, sometimes a small building, 20, 30,000 square feet of free to lay, might cost $400 a foot all in. By the time you lease it, maybe $350. They're more expensive, they're food grade. So in areas with a lot of population growth, your existing industrial it's going to need more industrial that we have, these smaller service buildings, but nobody can build them speculatively. It just doesn't make sense. The rents don't justify it. So we can go where population is growing and there's barriers to development. Rents should continue to go up and those markets should stay strong. A lot of our competitors just do outside storage, which is very popular. We do shallow bay and industrial. And what's nice for us is I think that a lot of the tenants use both buildings. One's with outside storage, one's without outside storage. So we're working with the same tenant pool. And some of our competitors that are larger, or not larger, but they're focused on outside storage, are limited in what they can buy. So we can buy a 100,000 square foot building with 2 acres of yard, no problem. So I think it's just a little gap in the market that we're filling. And there's a lot of synergies between iOS and shallow bay that as an operator I know, and as an investor. So we think doing both gives us more optionality. So I'll let the panel speak more on the market. They're closer to it than I am, although I am very close. I'll just say that by working with tenants, mostly in building materials, but not only, every real estate manager kind of says the same thing. Real estate's now constraining their growth. They're like, we have 40 locations open. We can only find the real estate for 5 to 10. And that makes me very bullish on the space. So even if there's a slowdown in the general market, these guys have a backlog of locations they need to open. They're doing more volume out of the fewer they have. But in a perfect world, each of the growing, and that's kind of across all of our tenants, it's just hard to find iOS. The vacancy rate is 4.3% across the country. And that's probably the most supply constrained market out there. And it's why we're in there. And on this slide, it's the same slide we show every year, which is good because it doesn't change. Under 50,000 square foot buildings have the lowest vacancy in the country. And low vacancy drives rent growth over time. And that's why we like to be, this isn't particular to iOS, this is why we like iOS kind of with buildings. Just gives us a lot of optionality. And when sometimes I get sent to articles on higher industrial vacancy, it's usually, although not always, in the larger buildings. A 500,000 square foot building, a 1 million square foot building can really drive vacancy up in the market. We dial into what's the vacancy for the building we're buying, which is less than 100,000 square feet usually. And usually those numbers, there's not that much on the market, giving us a lot of pricing power. So, so I'm really proud of this metric. The smaller industrial class B, the space with iOS it's kind of the Wild West, and we're executing. It's 90% of our acquisitions are off market. We're not really chasing marketed deals. We do execute on them if we have a kind of an advantage or a tenant in tow or some kind of edge with it. But 90% are off market. 30% are direct to owner, and 30% are through broker relationships, and I guess 30% are through tenants. We bought 4 or 5 Frito-Lays last year, 1 in Dallas, 1 in Fort Worth, El Paso, Chesapeake. They're vacating in a year or two, and it gives us time to refill the building. They were awesome buildings, and I think they're going to be great deals. One of them we're already pretty well stabilized on. So if you're just competing in the market, I don't think you'll generate the returns that we'll generate by finding deals off market that we have either more knowledge on or a seller that doesn't want to go through the fixing up the building process and just wants to exit at probably if they own the building for 30 years, it could be 4 times the value they initially paid for it. So I'm very, very happy with the team on this part. Yeah, and we've done a reasonably good job diversifying our capital, which is just good for a healthy firm. We have high net worth investors. We can always use more. We don't really, me and Rob don't aggressively sell the high net worth because you have to kind of boast about everything that you're doing, and we like to deliver the results. So if you all know more wealthy people that, we've done well, we'll always take more referrals. We can do better with that. But a lot of our friends and family investors have been with us for a long time. And, we're always happy to, bring on new institutional partners, especially as we want to buy lower return deals over time as the space becomes more institutional. We see a lot of opportunities there. And different people are kind of looking at different things. But it's good for us to have a diversified base. And it lets us be creative with new investments, and that creativity hopefully lets us maximize returns. Yep. So this is kind of when we started looking for more outside capital. It's been a journey since 2021. I've enjoyed it. It's I guess we've raised cumulatively $400 million since 2021, and we have the infrastructure and the team that we feel we can continue to responsibly add to that, and we're looking forward to it. We really want to be best in class in our space as the space develops, the IOS and shallow bay. And I feel anybody can kind of go out and find good acquisitions, but we really have to focus on our results and executing on leasing, executing on construction, and bringing it together. And that'll amplify our returns, which will allow us to do more acquisitions and grow. We, at this point, we've been doing it for a long time and have a fair amount of relative experience. So, thank you. I guess we'll do questions later if anyone.
Yeah, we'll do it later.
Let's pick up the program.
Morning, everyone. For those of you who don't know me, my name is Danny Harrison, one of the principals at B&D, responsible for leasing and development. Martin talked a lot about our history, but prior to B&D Holdings, my grandfather started Bradco Supply, which was one of the nation's largest roofing building distributors. I started when I was about 14. I did everything from cleaning floors to delivering shingles, and eventually working a little in headquarters as well as inside sales. So personally, I have operational experience, but nothing to Martin's extensive experience as a hands-on operator, which informs us how we source, underwrite, and manage assets. We prioritize our core principles, as Martin's discussed: functionality, access, and operational efficiency. Our approach leads to stronger retention, lower downtime, and long-term value creation. This experience and knowledge has led to our long-term, strong tenant relationships. We speak with these tenants on a weekly basis. Pretty much every day I'm speaking with a head of real estate from one of these tenants. Our core portfolio is about 200 plus properties nationwide. Out of that, we have 80 unique tenants. This is a really exciting and healthy building to tenant ratio. It really allows us to get to know our tenants, build relationships with them, understand what they need, understand where they need to be, how they want to grow, really leads to more business. And then we have 28 active searches that were given through tenants, and 5 total new construction projects that we're working on currently. Those are in various stages of planning right now, and we hope to break ground at the end of this year. The relationships, they allow for new leases, early renewal negotiations, tenant-owned sites to acquire. We acquired a few owned sites that Martin mentioned through Frito-Lay, but as well as other tenants provided us sites to acquire last year. Market intel and build-to-suit opportunities. But they also create other additional opportunities by speaking to brokers in the market, calling off market sites. We're able to find off-market, high-yield sale leaseback opportunities, as well as value add. So it's a big deal generator for us. On the leasing side, momentum this past year and year to date has been incredible. We completed about 38 leases, a little under 800,000 square feet. Saw a huge mark-to-market from 634 to 1038, which was a 64% increase. Really just demonstrating our market adaptability and value enhancement. To dive into more detail, this is just a breakdown of some amazing mark-to-market examples. Specifically, I wanted to go over a few examples on this sheet. One of the examples is Glendale, Arizona, which was a 56,000 square feet on approximately 13 acres. We had a strong tenant relationship, and in renewal negotiations, we learned that the site was too large for them, and they couldn't handle the market rent for the entire site. There was a large demand for iOS in the market, so we strategically structured a new deal with them with a long-term lease, bringing them to market with a 77% rent increase from their previous rent, as well as retaining 5.17 acres to lease for iOS. We have that on the market today with our tenants still in the excess land paying rent, and we are negotiating an LOI, so hopefully the mark-to-market story next year there will be even more impressive. And then the second story is Pensacola. So in Pensacola, this is a great story of how our team overcame significant infrastructure challenges through our network. We were negotiating a lease with a national tenant, but that lease would have required about $1.2 million in improvements to upgrade the sprinkler system, the ESFR. We didn't stop our marketing process as well as our tenant outreach. We have a monthly email blast that goes out to all our tenants, all 80 of them, that show all our vacancies in our portfolio. It leads to a lot of our leasing year round. So in this blast, one of our tenants got back to us almost same day saying, I need a property yesterday. And we were successfully able to negotiate a 62% market rate improvement with that tenant with minimal improvements, and the sprinkler system was adequate for their use. So it was a great deal. And then finally, something that's not on this list, not everyone on the team knows, so it's kind of an exciting one. But we have out for signature in Albuquerque, Fleet Pride, which is going to be 110% mark-to-market achievement, going from $4.76 to $10. And that is out for signature right now. To dive a little bit more into detail, this is a case study on Charlottesville, Virginia. Last year, we acquired approximately 14,000 square feet on 12.6 acres. It's an incredible market. One, just amazing to visit if anyone gets the chance to go. But it has incredibly low vacancy due to the tough topography and supply constraints. We sourced the acquisition through a broker relationship we had for about 7+ years, and is a good friend of mine and the rest of the team. Once under contract, we distributed the property to our proprietary list of tenants, and we quickly identified Ferguson was interested in the property. We negotiated under contract a 10-year triple net deal with Ferguson at a 7.75% yield. At the same time, agreeing to a 6-month sale leaseback that allowed us the time to offset our carry costs for the special use permit we had to get for Ferguson. The special use permit was to allow them to store outside storage. I'm excited to share that we hope to have the special use permit approval within the next 2 months. and we're going to be delivering the site to Ferguson approximately 5 months prior to our initial thesis. In today's market, we believe this is a 6.5 cap or lower, so creating 155 basis point spread and, strong future capital event through either a refinance or sale. On the development side, we have a nationwide comprehensive build-to-suit program with sophisticated site selection, complex entitlement navigation, rigorous financial modeling, precision construction management, and strategic asset disposition. We've done 19 projects to date, a little over 245,000 square feet. In 2014, we had 6 projects completed with 12 active projects ongoing throughout the year. And we spent about $60 million in development costs. One of the things you'll notice on here is really the evolution of our partnership program with Frito-Lay. As time went by and we showed our skills and expertise in development, they went from giving us 3,000 to 5,000 square foot buildings to 20,000, 40,000, and eventually an 86,000 square foot build-to-suit, which I'll go over in the next slide. To date, we've completed 19. We've sold about 12 properties for a little over $100 million. We have 4 under contract for a little over $25 million, and we're hoping to sell the remaining 3, which are on the market. If anyone's interested, let me know. And finally, we included 2 of my favorite projects. Both projects we completed within 10 months of groundbreaking, which is great timing. And then Cedar Falls being the largest project we've done to date at 86,000 square feet on 13 acres. That's just an extremely exciting Class A, beautiful building. We actually just got the Cedar Falls Award yesterday that our partner went to receive. That probably will be on our LinkedIn probably end of day today or next week. But fun little thing. They put together a 1-minute video on our project, so we'll get that out to the world. Then on specifically in Hurricane, Utah, I wanted to talk about really how we solved a massive problem. The industrial park had a CC&R restrictions that prevented buildings from having chain link fencing, dock location in the front of the property, building facades had to be a certain color. I could go on the list of violations that restrictions this project had. Our tenant wouldn't go into the property without the restrictions lifted. They didn't want to have any concern about being kicked out. Frito-Lay has thousands of locations and they've seen everything happen. And the site was perfect because in Hurricane, Utah, it's mountainous, the topography is an issue, and this was the perfect site. So we navigated the complex issue, and we personally engaged over 100 property owners in the complex to receive the required 65% signatures to completely lift the covenants. There's no longer any restrictions or covenants, which created a huge value for not only our team, but also all the owners in the park, because out of the 100 we reached out to, about 100% of them were in violation. So nobody contested. And that's our development. And I will hand it over to Rob Logan to discuss the panel.
Let's go, guys.
Julie.
Ready? All right. We get to sit in these cozy chairs.
This is nice.
This is nice. All right. I'm very excited about this today, most importantly because you don't have to listen to us, but especially because Justin and Bill are leaders in the industrial field. So I'm going to do brief intros, and then we'll let them tell us all the good, the bad, the ugly, the great about the industrial world. All right, so Justin, who is a friend and has helped B&D, we've worked with him closely. He's sourced a lot of capital for our team. So we didn't just pay him to do this. We have a relationship with him. Justin works at Cooper Horowitz, family-owned capital markets advisory firm. He specializes in debt and equity placement throughout the country. Prior to Cooper Horowitz, he worked at Saville Studley on the New York investment sales team. And prior to that, he worked at Brickman, where he focused on management and leasing of their New York office portfolio. He has been specializing in the iOS and industrial space. I think it's an understatement. He's Mr. iOS in the debt world, and he's financed over $2 billion of iOS assets. He's placed LP equity, and he's even sold real estate. So he's really positioned himself as a leader. As iOS has grown, he's doing a lot of the largest iOS portfolio recapitalizations in the country. So,
and I didn't pay him to say that either.
Yeah. I added that. Thank you. Bill, also a friend and has worked closely with us, just helped us very closely on our recap, which we're very happy, and we'll elaborate a little bit further on that. Bill is a leader in mid-Atlantic industrial space. He's a senior managing director at JLL with over 35 years of experience in commercial real estate. Based in the mid-Atlantic, he's completed more than 210 transactions totaling over $8 billion across industrial, office, land, and mixed-use assets. He's a member of JLL's Supply Chain and Logistics Solutions Group and has deep expertise in sales, sale-leasebacks, equity structuring, and debt placement. Prior to his capital markets focus, he was a top-producing tenant and landlord rep, advising major corporate occupiers and institutional owners. Nice job, Bill. All right.
Ouch.
All right. So, Justin, let's start it off. You've done an incredible job putting together some large portfolio transactions, as we just discussed. Well done. Before we get into any specifics on some of the deals, which I'd like to discuss, can you walk us through how it has evolved and how you've seen it evolve over the last few years with more capital coming into the space?
Yeah, so the space has institutionalized on the iOS front over the past half a decade, which is when I started to focus and really pivot my career towards iOS. What was originally on the financing side, regionals and local banks and debt funds throughout the country, has now evolved into institutional equity and as well as debt providers like a Blackstone, like a New York Life. Life insurance companies, I would say, is the biggest entrant into the space over the past 18 months. We've done quite a lot of pension fund financing where I think 2-3 years ago, we were putting presentations together for clients like B&D and other folks in the space that we would go out for financing. We would put together about 5 pages on what iOS is, really explain it and get in front of credit committees early. Now we're just putting together a presentation of who the sponsor is, what the opportunity is. It's its own asset class at this point. It's no longer we have to explain what it is. That's definitely point A. And point B, just to hit some of the names, and we'll talk about it in a few as well, of the institutional capital that is in the space. We just did Blackstone's first debt deal in the space with Altera for $189 million, 49 property, 22 state portfolio. That closed in about January. We're now in the market with a little over $600 million of new debt placements. 2 of them are about 140 and 180 million of debt. And we now have names like an Affinius and Acor. I did just mention New York Life, like these institutional capital providers that were not in the space previously. Now that Blackstone is in it, everyone's chasing the market. Where 2 years ago, we would bring up the asset class to a Blackstone. We're not getting into it. We don't want to be in the space. It's too granular. Now they seem to be the top dog in the space. And every deal that we're in the market with on a 9-figure basis, everyone calls us and says, how do we beat Blackstone? So now you know it's really institutionalizing.
That's what we like to hear. Yeah. All right, Bill, do you want to just tag on to that?
Sure.
Yeah, great.
So what we've experienced, to pile on to what Justin said and what Rob started with, is that universe really, to the most important point, started in 2020 to validate iOS. Shallow Bay was always out there. Shallow Bay was the original industrial. It got gritty. It was fractured and fragmented in terms of ownership, and it was really hard to roll up. When iOS came on the scene, we're currently tracking 59 different operators of iOS in the space. That should tell you a little bit about how deep that bench is. But when you really separate those groups out to groups like B&D that are doing more of it on a formatted basis are vertically integrated internally, that field winnows down pretty significantly. In terms of the fund capital out there, there's $19 billion of fund capital that we're tracking that represent both the operators and the sort of 14 to 16 ventures that are all in iOS. All of that's happened in the last 5 years. We're talking about an average age of industrial that's probably 30 to 32 years. So for a product type that's been around for a long time on average, to see this much inertia in such a small period of time, concentrated in the names of Blackstone, Stockbridge, Carlyle, HIG, or I mean, we can go Meadow. Every operator and every capital partner has sort of gravitated to the best of the best. And a lot of the things that Danny mentioned, we'll talk about a little later, but those are really the differentiators that we're seeing. There's a difference between owning it and knowing it.
Yeah. Okay, so I want to get back into some specifics, but I don't think the audience would be satisfied if we didn't bring up what's happening in the bigger bad world right now. Maybe the elephant in the room, tariffs, and maybe no one has the answer to this as it changes daily. But are you seeing any impact on any live deals from this?
I was actually just in the UK touring with quite a lot of the top iOS aggregators out there, and a lot of the equity names like an HIG or like a Blackstone, real term NW1. I was sitting down before lunch, and on the front page of the Financial Times, it said that U.S. cargo in the port of Inland Empire is down 30%. And there was no source behind that. It just said that. And I thought that was super interesting, that everyone thinks they know what's going on. I personally have no idea what's going on with tariffs and how it's impacting the ports. I will be at the Port of Virginia next week and the state of the market there, so we'll have some real-time data. Where we have seen some of the positives from the tariff news is on some of our clients in the space that do have domestic tendency that is, whether it's pipe laydown yards, lumber storage, or any sort of building materials, and obviously equipment rentals. I think that those leases are still getting done. There still are a lot of tenant demands for those spaces in the market. We are in the market again with one of these larger refis in the $180 million range, where about 11% of the rent roll is actually coming from tenants that are either cross-border or from tariff or tenants that will be impacted by tariffs. So that question's coming up often, where the rent roll is about 11%. On a property basis, it's only about 3 properties across the 29 properties that we have. So lenders are obviously concerned. They want to know what's going on. With respect to kind of spreads and where that's coming from on a lending basis, prior to tariffs and all the news that was going on in the value add space, we would have been guiding and were guiding spreads and call it the 250 to 265 over range. We've now gotten bids and close to 12 term sheets on this one portfolio that I'm speaking about. We have 12 term sheets. We have bids and now call it the 275 to 285 over range. No lenders out of the market. There is obviously a lot of news. So what would have gotten done 20 basis points inside of the tariff news, we still have quite a lot of interest, and no one has backed out since then. I don't have an answer of what's going on and how that'll impact just yet, but I think Virginia will be telling next week.
Okay. Bill, anything to add on any deals you're working on?
Real quickly on the tariffs, where we haven't seen the impact and where we've started to see stabilized or increasing leasing velocity or decisions being made that were maybe a little bit slower, is in that sort of sub 50,000 square foot tenant size. I think where we've been hit more so optically is just the major retailers that are very port-centric, that are very heavily supplied by outside U.S., non-U.S. manufactured product. So I think, you pick the Lowe's, you pick the Targets, you pick the product that's coming from the countries with the highest tariffs, where we're experiencing some headline question marks. I don't think we've necessarily hit the concerns yet. And then in our world, some of the capital markets transactions that are happening that are anchored by those tenants are more affected, frankly, by the 3PL industry than they are the actual occupier itself. So as opposed to a Walmart or Lowe's or Target, it's the 3PL for that particular group. And depending upon how much product they front-loaded, we're actually seeing, in some cases, resilience. And we're getting on the 10 interviews in these transactions and hearing firsthand their concerns, confidence levels, and I would say we're probably right at a baseline. I don't think there's a panic button being hit. I don't think there's a headline that we're grabbing onto that says, anything's changing in a material way for the long term.
Okay, let's dive back into a deal. Justin, so you brought Blackstone in. It's fun to talk about. What drove, any comments on their interest in the space? Obviously, Martin just talked about the market. Everyone likes iOS and shallow bay. That's why we've been doing it for a long time. But what made them the winning lender? What are they doing? What does that mean for all these deals you're launching now?
Yeah, so that was a portfolio loan that we did with Altera, who is a discretionary fund. They're on their third venture, and they've raised about $925 million for iOS exclusively in the space. We launched that in about the end of October. We ran a full process, went out to close to 85 lenders on that portfolio, of which 55 were about dead on arrival. It was good for the lender sheet and just to get the name out there of iOS and the sponsorship. The remaining 30 or so lenders, we had close to 15 term sheets, all the life insurance companies, pension funds, debt funds, banks, and of course Blackstone, the big gorilla in the room. I think that the reason Blackstone really enjoyed this portfolio the most of anyone that we've kind of put in front of them at this point, and prior to that, it was Altera. So obviously they have a big discretionary fund. They own close to $3 billion of iOS in the space. I think that they've been trying to get into the space on the debt side in Blackstone for quite some time. I think just having a top-tier sponsorship and going into the space with firsthand, I think that was also a big advocate for them as well. And there was a lot of dynamics of it. It was about a 6 debt yield going in, stabilizing to a 12. So there was that mark-to-market story. There was the sponsorship story. And it was also 22 states. So you could put some dots on the map, an investment committee as well, and kind of diversify the portfolio. There was an add-on feature to that as well. So what was $189 million out of the gate allowed it to grow to $500 million on an acquisition basis going forward. So I think just having sort of that relationship to go forward was super important for them. And now, and like I said, on all these other 9-figure portfolios we're working on, all the lenders that saw Blackstone in and unanimously approved that in committee, now everyone's saying, how do we beat Blackstone? And I don't think Blackstone should win every deal because that might hurt the market and the marketing efforts, but they're certainly very easy to work with and understand the space. I think the one thing I want to hit on quickly about that deal, we just closed a loan for JP Morgan and Zenith. That was about $120 million. It was a 10 debt yield portfolio. So the first true 9-figure iOS portfolio that got done in the space on a fixed rate basis at a sub 200 over the treasury spread. So first sub 200 over, first 9-figure loan in the space, and a 10 debt yield as well. So any lender that we're going out to the market with now on a value add proposition, on a cash out refi, they ask what's our takeout, what's going to happen in a few years when our loan is at an 11 or 12 debt yield. We now have the market color that shows there's a pension fund out there. We had 4 other life insurance companies ready to do the deal, 3 other banks that were willing to do it, and we had CMBS, but we decided to go the balance sheet route. So I think the takeout market is very important right now for these 9-figure and lower loans as well. Like we've worked on quite a lot of $1 to $50 million loans as well. That's very important. The takeout's very important. And now Peakstone, I want to touch on quickly, is in the space. That's a REIT that just bought one of Altera and JP Morgan's first vintage iOS portfolios for about $500 million. That's something that's changed too over the past 5 years, where REITs weren't in the space, now they are. We barely scratched the surface of Odyssey funds. Those are starting to become created and come into the space as well. So that was a really exciting deal, the Altera one with Blackstone. I think it's just institutionalized the space to a point where what was probably getting 3 to 5 term sheets a year and 2 years ago are now 12 and above.
Sounds like I got to do bigger deals if I want to. All right, Bill, let's change gears, but talk about something in your backyard. It's somewhat pertinent to what we're talking about today, just impacts on land and industrial use and available land. So let's talk data centers. You're a Northern Virginia guy. With land being absorbed so quickly, how's that affecting where you focus, what's going on, uses, investment?
Yeah, so right now, if we tracked it, industrial is so hot in Northern Virginia for lots of reasons. Land pricing right now is probably $4 to $5 million an acre at the peak. And there seems to be no end in sight. The minimum size, lot size, and acreage size for that occupier used to be hyperscalers, 30 plus acres. Now it's somewhere between 5 to 10 acres as a minimum. and they're not discerning necessarily in pricing between one to the other. It's all related to power. But what it is doing is it's displacing about 5 to 6 million square feet of industrial occupiers just in that node of Northern Virginia. And you saw Danny's slide, and that mark to market of 64%. 11 of those deals were in Virginia across your entire portfolio. So we're experiencing that deal over deal. And what we're starting to see is one thing Justin mentioned, which is the liquidity in that space. But just sticking with data center, there are right now, in terms of our tracking, somewhere between 6 to 8 occupiers and developers of every industrial deal that we bring to market that could go data center. And there are going to be winners and losers in that space. But what we've seen is marking to market in some of these markets that are so close to the data center alley of Dulles, Manassas, our our western but still Metro DC market in Northern Virginia, is triple net rents right now of 20 to 21, edging toward $22 a square foot, which frankly exceeds the highest point that office has ever achieved in Northern Virginia. So couple scarcity, supply, zoning and overlays, the inability to build, with what we're seeing is that displacement, and it resonates that these tenants are going to have fewer and fewer options. Rents are going to go up. Vacancy is already really, really low in the market. So in terms of data center runway for us, the next frontier, and you guys are kind of front end on that, is heading south. You guys recognized years and years ago that the labor and fundamentals are great in Richmond. Port of Virginia is doing extremely well for port-related reasons, but also because of labor reasons. And that data center community is now transitioning down 95 to Richmond. And you guys are there for data center suppliers, the groups that are getting displaced by data centers, to try to see that rent growth. We think that frontier probably goes all the way down to Richmond, probably doesn't get to the port necessarily, but it's a really good story in terms of our data center displacement. And it speaks to where those tenants have to migrate to, and they're going to have to go further west, further south, smaller assets, and their throughput requires less focus on whether or not you get 28-foot clear traditional Class A. It's more space availability. So you guys are in a good position.
See some family members excited because they own in Winchester, so that's probably a good thing too.
They're going to be crushing it.
Yeah, there you go. Nice. All right, let's get back to iOS and Shallow Bay. It's evolving. There's more institutions getting into the space. I think what's interesting for our investors to think about is, obviously we like what we do. We've achieved attractive returns. We're still seeing great opportunities, building a good team around it. But why this versus a Class A shop versus another asset class versus another part of industrial, right? So I think what's be interesting, if you guys are seeing, what is the comparison to how capital is looking at kind of Class A big box or even Class A shallow bay? That means new stuff that's pretty versus what we're buying. And what's the appetite for that? Maybe Justin start.
Yeah, I think the appetite on, and I know we're talking quite a lot about 9-figure loans and bigger deals, but we've done, like I mentioned, quite a lot of smaller ones as well. So in tracking kind of the $1 to $15 million space, and the average is around 6 to 7 deal size, I think there's quite a lot of institutional interest there because the yields are much higher. I think you can get into a space where I think a lot of the larger institutions are looking for these, call it $20 to $100 million deals on a per deal basis. So where you guys are succeeding incredibly well is that you're under the radar finding these smaller one-off deals. And I think I saw one of the slides was 90% of the deals are off market. Anytime that we get a phone call for a deal in the Mid-Atlantic for a client that's not B&D looking to acquire there, I always think to myself, well, why did Rob pass? What happened that they didn't see it? And they probably did see it, but they're getting the next look. So I think that's where you kind of have that competitive advantage on the off-market side. There are brokers that are finding quite a lot of deals in that space. And I think just the larger deals are being chased by the higher top-tier equity shops and just want to focus on that with hours of their teams being spent on that.
Okay. Can I pile on that really quickly?
Yes,
please.
I think the maturity of this product type has been slower because there are three things that really factor into it. One is the time intensity it takes to acquire a smaller transaction. Two, the fact that you're not always dealing with a credit tenant, and if you are, you may not have a relationship with them beyond that one building. Whereas you guys have affinity relationships across your portfolio. And then the final is management intensity. People see a rent roll that's a 40,000 square foot building with 5 tenants, and they're thinking that's probably not a good use of their time. But that's where, frankly, we've seen the highest percentage of return. And then the other piece of that is liquidity. So the liquidity always used to be another user, which was not quite as well developed a market, or a private 1031. So those were the two options if you were thinking about selling a building that was under $10 million. Today, over the last 5 years, we've seen it and tracked it. But JP Morgan, stock, you pick the pension fund, Principal, they all have separate accounts, and they're all looking for smaller transactions because they've realized that the return parameter for a Class B transaction in a core market, especially infill, is going to wildly outperform. And then lastly, 5 to 6% of the overall growth of industrial has been in shallow bay in the last 15 years. Compare that to roughly 40% of overall growth in inventory to multi-tenant assets, and the balance of that is single-tenant deals like you guys have done with Frito-Lay, generally bigger transactions. So you add the liquidity, the scarcity, the barriers to entry, and if you can focus on it, infill, well-populated, strong labor markets, it's an easy formula, but it's hard to execute. And so if you can scale it, great. If you can add your overlay of integrated services to it, you're going to attract capital, but you're also going to attract the higher quality credit tenant who wants to know this isn't your first rodeo.
Any specific answers as to spread differences versus Class A and kind of Class B iOS shallow bay?
50 to 90 basis points between Class A and shallow bay.
Okay.
But what I would argue is that difference in yield is more than made up by rent growth. Yeah. So, your shallow bay is probably escalating by 6 to 8% year over year in terms of rent growth, same store, but your institutional quality product is maybe ticking along at 2 to 3%. So you change that cap rate argument, and optical cap rate sounds great. So you're jumping in at that 50 to 90 basis point spread. But what you're not necessarily calculating is you're getting the multiple on rent growth. And then the last piece of that is the stickiness. These tenants don't have anywhere to go. And if you can grow them in your portfolio and you have enough of a scale in a market to say, I have a relationship with you, let's meet once a month. Oh, you need more space or you need more outdoor. Let's figure out if I can maybe move this tenant here and move you here. So that's only achieved through scale. You can't just do it if you're a one-off owner.
And Martin said that as well, to just piggyback on that, like you have over 200 properties. I know we're talking quite a lot about B&D, of course, but to have that scale and to be able to say, hey, Ferguson, we'll move you from here to there, that's a pretty top quality credit tenant in that you can actually move within your portfolio that not a lot of other operators in the space can say that they have. I think that's very important. And to your point about the 50 to 90 basis point gap as well, that's how we're seeing it in the financing market too. Okay. Where I think traditional industrial is getting kind of that mid ones over the treasury for stabilized deals. It is kind of in that higher ones over for true stabilized deals as well for iOS. So it's kind of in that 50 basis point increase.
Yeah. Well, and I've got a 1 in 4 chance of actually doing a deal with you guys between direct marketing and broker deals. So that's great.
When Bill sells something, I don't like to buy it because he's too good at his job. You can sell for us, but we don't like to buy from you.
I think this is really a fundraising effort, Mark. Yeah. I'm not high net worth, but I brought my checkbook.
Yeah. How are we doing on time? We have some time. Is there any questions coming in? No? Okay, great. Okay, we'll keep rolling. I wanted to talk about AI, but it's really, and then Danny advised me to talk about tech and real estate. So it's twofold questions. One is, maybe this is Bill starts, obviously you talk about data centers, but how about just technology and real estate, and what are you thinking about over the next 5 years at JLL as a whole, right? Power, robots, parking, I have no idea. And then AI, we just want to ask you, when do you guys think you're losing your jobs to AI? So that's second one.
I think we're making our jobs easier because of AI.
Okay, good.
But I'm not going to touch on the robots and any of the other technology that you're referring to in that respect, but I would say for our tools and technology, something that's been a game changer, and you guys have seen this with us, is a program we have called Horizon. Essentially, we can take any one of the assets in the market or the assets that you own and clone it, and then clone it across geography. And we clone it through multiple filters. So it's short-term trigger, what is the loan maturity? When did they buy it? What's the fund life maturity? What's the tenant's lease expiration? So we pick all these different features and then we clone the asset to figure out how we can replicate, maybe not the exact return that you guys are showing, obviously, but something that fits and is accretive to what you're doing. So that's one thing we've been doing. The other thing that's frankly harder, but we've been getting better at it, is taking programs that help us get more efficient at identifying new buyers. And I know you don't necessarily like to hear that, but the reality is what we're facing is a fractured market, as Martin mentioned. And what we're trying to do is get smarter about how to not spend time with buyers that are long nose and groups that are, faster yeses. And frankly, if somebody's got 19 Frito-Lays and we're selling a building with Frito-Lay, then that's got to focus attention for us on that being 50% of our buyer pool versus forgetting about them or not knowing about them.
Yeah, I'm actually just a hologram. My real body is in New York right now, so we've already kind of figured that part out. I would say that we're spending quite a lot of money into kind of the leasing and sales comps of the space, like Martin and the rest of the team have said. Very fractured market. Not many folks have the data and the lease comps and sales. Bill probably has quite a lot of that as well, and we're lucky in the brokerage community to have that because we have folks like B&D that will call and say, we're buying a site in Manassas, what are the lease comps, what are the rent comps, and the sales as well. So we're putting quite a lot of money into the tech to be able to build out a database, to build that out so that we can answer quickly and give real-time data in the space. So I think just while this is still fragmented, while we're still in this 1.0 of iOS, just to be able to give our clients the best real-time data quickly is very important.
Okay. Any commentary on primary, secondary, and tertiary markets? I know Martin said earlier we don't really go to tertiary markets, which is true. But at the same time, sometimes I always like to think about if I'm in a tertiary market, as long as I'm kind of in the, and nobody knows the definition of these things anyway, but so we don't know what that means. But if I'm in the inner ring of kind of people, there's some kind of natural barrier or whatever in a tertiary market, it can still be an excellent investment. But there's implications. Who are we going to sell it to? Do lenders want to lend us money in those markets,
Right.
even if it's the best piece of real estate in said tertiary market? Any change, any thoughts? Because I feel like it's not just big box on the coast. If you're going to get into this space, you might have to go there.
We start backwards from investment committee presentations. So can I get this transaction through an investment committee at an institutional level? If I can't, I'm almost tertiary by definition.
Yeah.
So I'm thinking about my liquidity at one level, but I'm more importantly thinking about who my buyer is. And then who my buyer is impacts how my pricing is going to go. So I've got to have a really good story for why that market may be emerging. So I'd take Richmond as an example. It's almost like Dow, NASDAQ, and S&P. So tertiary could be the NASDAQ, but it could as well be, a very, very challenging exit strategy. And the primary market is the Dow, and the S&P is maybe the secondary market. But the reality of that story is if I've got a tenant story, if I've got a power story, a data story, a labor story, a port story, every story is going to be a little bit different, but it has to pass that filter for us at least. And then there is a steep fall off, back to your point on pricing and discounts or premium and cap rates. That yield spread is tied directly to institutional capital job security. So I'm not going to get someone who's going to beat the drum, risk their job, and go to a market they've never been to, that they're fearful of liquidity in, unless they're going to get an extraordinary deal. And so I think I'm a big believer in secondary markets. I think there's yield spread there. I'm a believer, obviously, in the stability of a primary market, and I can be a believer in a tertiary market, but we're digging deeply into that. We've got a deal that you're going to see in about, hopefully, 2 weeks. Secondary location a little bit. Love the drivers. 2 of your top 80 tenants are in that project. That's enough of a validation for us to say, okay, they chose it. And then the user purchaser market is an interesting story because they've checked kind of 2 boxes. The labor story, cost is secondary, and then supply chain. And they've owned it. I actually like the story of an owner-user because they validate the location in many respects, but they aren't always thinking about obsolescence in the same way. But I do like all those stories, and I'm a big believer in tertiary, but it's got to be the right story.
Yeah, we're about to do our 29th state in the iOS market in Montana, and so that's very much to what the lenders like to call a tertiary market. So the way that we're pitching that and the way that we're explaining it to the lending market is that it's a rental company that is AA credit. It's really great tenancy. It's 9 years of WALT, no outs in the lease, 3% bumps. So it's really great credit. It's just obviously in a tertiary market to the lenders. So the way that we've talked to our clients about that is let's bring in another property that is in Kansas City, which is still technically secondary. Let's bring in a deal in New Jersey. Let's make it a smaller portfolio that is anchored by the Montana portfolio, but has more dots on the map. And so that's about an $8 million loan where we have life insurance interest because of that long-term WALT. We have regional and local savings banks as well that are interested. But on a standalone basis, even with that credit, even with that WALT, it is a struggle to get people interested in that because it's tertiary.
We might buy it so we can go fishing and skiing if you want.
That's a good idea, yeah.
He's a good skier, I can promise you.
Yeah.
All right. Maybe can we just expand a little bit more? This is I think we're going to end. And no more questions from YouTube? The YouTubers are silent? Okay, all right. Let's just talk a little bit about roll-up. Martin alluded to it, how there's been a lot of people who have built 10, 20, 30 property portfolios, but maybe it's 2 or 3 guys in a Bloomberg sitting in a room in New York City and they don't have a 30-person team. So we see some natural portfolio exits there, but then obviously we have the big capital coming in. So how do you think that will, occur over the next 5 years? Is it just 2 or 3 mega users, or is it multiple? How do you think?
I think it's really interesting where you have, in the iOS space, I mentioned 1.0, and my favorite panel question is what inning are we in? That's always been my favorite. I think you look at, on the iOS front, you can have someone whose 2 brothers have an apartment that has institutional capital behind them and has about a $100 million GAV portfolio. Are they really thinking about the next steps and bringing on a CFO, bringing on back office and accounting? Or is that next exit a B&D and an institutional partner or yourselves? I think, and then you think about the Alteras and yourselves, and that there's really like an A to Z of investors in the space right now. We have had REITs enter, like I said, with Peakstone. We've barely scratched it with the core plus funds that are truly dedicated to those takeouts. So I do think we're in this really early stage still of iOS aggregation where yourselves, the other folks we've mentioned that are really building out these great portfolio deals that will look for an exit at some point because of an institutional partner where there's a short-term hold period. And so I think there's still a lot of runway for these roll-ups to go.
I agree. It's really hard to aggregate the portfolios that you're looking for. And frankly, the amount of capital that's raised reminds me of every other product type that's gotten mature in a very quick period of time, and people start raising. So obviously, when the market is a little bit more challenging, people are thinking about getting through the challenge and raising core plus and core capital. Prior to that, when the market's doing well, they're thinking about trees don't grow to the sky. It's probably going to be value capital next. I think for this market, it's been raised so quickly with so many great names that you've worked with and that have probably approached you guys and said, "Hey, we'd love to buy you guys." That I think it's going to be increasingly difficult to see them hit their multiples unless they go big. And go big means probably overpaying on a multiple basis. And then frankly, thinking about a way to institutionalize the vertically integrated piece, which is controlling your tenant base, controlling your property management, your expenses, and then growing in a really smart way, which is frankly, and you know it better than anybody, Rob, it's knowing what deals, to your point, you don't want to do and why. And passing on those quickly so that you can move on to the deal you do want to do. But doing that programmatically is really hard to build out.
Yes, it is. Any questions from the audience here? I think we have just a few minutes. Yes.
I think the multi-family space, but one of the girls were dealing with property taxes and insurance, specifically. I'm wondering, they're not set up. These two girls there on the expense side. That asset class, specifically insurance.
Is the question specific to multifamily or how this
No,
product? So for this product type, it's a great question. He's got a booming voice. It's good. I think we would tell you that it's something we're looking at pretty heavily now because it's got to be managed against rent growth. So a lot of these assets have been owned, controlled for 20, 30 years. Maybe it's a family that's owned it. Maybe it's the business that they sold to someone as a private investor. But that may have happened 10 or 20 years ago. It may have never happened. So what's going to happen when it transitions to institutional ownership is counties and jurisdictions are looking at those taxes, and you're going to have to manage how far you are off of assessed value and how aggressively that jurisdiction, I know you guys dig into this, how aggressively that jurisdiction reassesses. So certain jurisdictions are a little bit more lagged. I don't mean to say lax. They just, some of these smaller properties, you're not getting the assessor driving out there. They may look at the headline comp and say, fine. And the taxes stay the same and the pass-throughs are there. And you can still grow those rents, same store, year over year higher. I think where we're looking is what that discount is. And we're doing this right now on a $120 million portfolio. And the fortunate part is that the gap is only modest. It's probably a 20% roll-up, and it probably never hits. So we can still grow our rents accordingly. But at some point, based on scarcity, the tenants are just going to have to suck it up. There really won't be a place for them to go, and it's becoming an increasingly institutionalized product type to the point where trade velocity right now, where it used to be once every 10 or 15 or 20 years, is now once every 5 years, 7 years. So the reassessments are happening more aggressively quicker so that there won't be that gap between buildings that haven't been reassessed, not having a high enough tax base, still being able to enable a tenant to, avoid that roll-up versus the other product types. Office got hit really, really hard. And especially now where, values are declining, assessors are looking at that and trying to figure out ways to raise revenue and maintain it. Industrial's got a little bit of a different advantage. I think they're focused on jobs, they're focusing on creation. Where you guys probably win is land value and low coverage isn't being looked at from an assessment standpoint the same way under roof is. And so that's a distinct opportunity, I think, that lower coverage assets have in the industrial world relative to heavily built out under roof space.
And just in case anyone online didn't hear, there's a question about the impact of expenses that have really hit multifamily owners, right? Because they can't pass through insurance and tax growth to their tenants. So they've been really hit over the last few years, especially as rents kind of flatlined for a little while. So a lot of people we know in the multifamily space have not done very well in their investments. We're fortunate in industrial, we're able to pass it through to our tenants for now. Hopefully forever. I will say that Martin and Danny, when we're speaking with our tenants, we're discussing total occupancy cost, right? So it is what's your net rent and what are your expenses. And a lot of times we have guys just calling Danny and Martin saying, I can pay 70 grand a month to be here. I don't care that's what I got. And then we tell them it's 80 and they pay it anyway. But we tell that's we're not, they are thinking about their cost basis, but for now the market is we pass it through. So we've been fortunate. Anything else? All right. Well, thank you guys. I really appreciate it. We honestly really thank you so much.
You bet. Enjoyed it. Thank you. Thanks, Rob. Appreciate it. Sorry.
All right. We're going to take a 5-minute break because we're behind schedule. So this says 10, maybe the next slide, but it's 5. All right. So everyone stay on schedule. All right.
You're supposed to do that. It's like, I just went out for the first time yesterday, just to exploratory fish. It's just heating up.
It's good. It's a good crowd, right? Yeah. We did good. Just
All of the basic organization, the and Brad code, over relationships, and relying on, you get actually, I find those independent, you capital space, is relying on practice now, like. So basically, the business that we're in is providing performance on people who are in our business form was the first one that launched in 2014, which at the time was generally known as hard money and really was an alternative to banking today, same way that the industrial industry has evolved from our space is very much play. And it's the same, so one of the things a lot of people market. Our business generally people who are mortgage brokers, who sort of gain small lenders as a way to capture more stress. The thing about us is we're real estate investors. We're constructive, we're vertically integrated company that construction, feasibility, loan services, capital markets, we look at real estate. Remember taking investment committee is very different from industry. We benefited by that. One tax policy. Long-term revenue all out. Pretty easy company on side. That's good. Our whole customer is really changed. It used to be kind of an individual looking out here and there, maybe building a back house and sit in Westfield or doing small corporate development. Now it's really small. If you look at plus small development companies, really large development companies, generally doing deals that are smaller nations. So our income out of $50 million, our average loan size is close to about $2 million. We generally are running $3 million under in aggregate. $3 million loans typically represent a number of different units or a apartment community or single family rental. Wall Street has a name for our space. Like long ago, it wasn't IMS. Long ago, there wasn't very. And so the key emphasis is toward transition. So sometimes either starting today, finish. Huge opportunity to go out and talk about how we are there's the industry that serves that purpose with capital. Additionally, there's a lot of front apartment projects, both rent area out there. So those would be the transitions. Other cases, maybe a bridge sort of thing where apartment buildings being used up or converted to stabilize debt. And then separately, there's a side of our business which I'm going to talk a little bit about, which really looks like traditional mortgages for investors. So, there's a wide talk about kind of coaches and people like that, paying for buying, short-term rental, operating rental, for long-term single-family home rental. That industry has been largely institutionalized a lot, but that's one of the things that homes, and they get long-term mortgages in that. Workly, limited for long. That looks like except it's so we originate and sell some of that. Everything else we either
Thank you. Everything else we either keep on our balance sheet or in joint venture through our Apollo relationship. So these are examples of the projects I talked about. This is a ground-up construction home in Nashville that we did and financed for a builder who bought the lot, built the house, and sold it. This builder had historically been a bank borrower, but for reasons that I'll talk about, got frustrated with the banks and their speed and ease of execution and funding draws. And so, we provide a role there. This is a house in Maplewood that someone bought, renovated, and flipped. And so a lot of the issues with these homes are the floor plans are outdated, the finishes are outdated, and it's really overwhelming for a buyer to come in and have to really gut renovate an entire house. Not to mention, there isn't financing for the end buyer to really do that, right? They can't get a Fannie or Freddie mortgage for the cost of acquisition plus construction. They can get a mortgage for a finished cost. And so the market sort of provides the need for somebody to be the intermediary, effectively the distributor of the finished product. And then this is 26 individual townhomes in Nashville that we financed a 10.6 construction budget, $50 million loan, successfully sold out and so forth. So that represents sort of our core product. So you can see our business. We've grown dramatically. Similar track to B&D. Last year we did about $400 million of sort of that core loan product. This year we're on track to do close to $700 million of the core loan product. Our goal is to get to about $1 billion in aggregate, which is pretty significant. The largest players in our space, and there's just a few of them, do $2 to $3 billion a year across all products. So we're one of the most significant lenders and highest quality operators in our segment. So why is this happening? What's the demand for capital? And the reality of it is the regulators are basically working for BD Capital, and we love them very much because they're driving everybody away from the banks. They made it virtually impossible for banks to provide financing to this segment for a bunch of different reasons, with the rules around real estate, the rules around underwriting and so forth. And then people are just generally frustrated with banks. And the same thing that happened in commercial real estate, where non-bank lenders replaced banks and to some degree life insurance companies and so forth, has happened in our industry. And so, our customers appreciate, the level of intelligence we bring to a project, the speed, the sort of relationship orientation, and they're willing to pay up for that in rate and cost. The project gets done quicker. Ultimately, in the long run, they see that as beneficial enough to pay our rates compared to a bank rate. This is a pretty interesting slide. This is just the fix and flip market. So this is from Wells Fargo. This sort of evaluates what is the total addressable market for fix and flip only. So those are existing homes that are dated. So think, 1970s split level house with an outdated floor plan and rooms and kitchen configurations that don't meet the needs of a buyer and a family today and needs to be renovated. They believe that the annual total addressable market is $65 billion, which would mean that at 70% loan to value, that the addressable market in just that segment of the space is $45 billion. That is just a segment of our business because we do plenty of ground up construction and new builds. So you can see sort of the opportunity, and very similar to iOS is it's a very fragmented business that typically came from small pools of capital within family offices or raised by some independent operator with investors and is now being consolidated, and we're leading that effort. What's happening in mortgages in general and in Wall Street in general is these are the top 10 mortgage originators in 2024. This includes traditional mortgages. And you can see of those 10, only 2 are banks, Chase and US Bank. Everyone else is non-banks. UWM, which has 8% of the market, that was the family that bought the Phoenix Suns last year. And Rocket is obviously Dan Gilbert who owns the Cavs. Kind of a fun fact. But you can see that the non-bank origination volume of the entire mortgage business is about 70%. And then of that volume, only 38% is what all of us would think of as traditional mortgages. Non-traditional mortgages like the DSCR loans I described or our business are now comprising a larger and larger share of the mortgage market. So the capital in that world says, okay, let me go back here, sorry. Where do I go and how do I get into it? And they partner with people like us. So you can see here, life insurance companies are really the big story in our space. Life insurance companies owned loans through buying securitizations or QSIPs or whatever their form was, or buying whole loans. That was really a small business. Today, Athene, which is owned by Apollo, and General Atlantic, which is owned by KKR, are the 2 largest buyers of residential mortgages in the space. Life insurance companies get certain treatment, given it's a residential mortgage on a balance sheet versus a commercial mortgage or something like that. So there's sort of endless demand for high quality loans. Well, how do they get them? They can buy them on the open market, or they can partner with originators like us, be very integrated, know their management team, build a system and grow. And that's what we have. We have a joint venture with Apollo that today encompasses a $1 billion commitment and is our primary capital source. And it's been great for us and continue to grow. And we receive quite a bit of inbound interest now from institutions wanting to break into the space, wanting to partner with an originator like us. And so what we're doing is continuing to focus on making high quality loans, product development within our segment, and sort of marrying the right capital with the right product and continuing to do what we do. We're excited. We're going to be sending out some literature on an internal private REIT that we're forming. And the purpose of this is we've just received a lot of inbound interest from individual investors, ourselves included, who say, hey, we really like the space. It's highly secure. You're in a first mortgage. There's good current returns. How do I get exposure to the space? And the best, most efficient way to do that is through a REIT that we're going to be introducing. And so stay tuned for that. We'll send some literature, and we'd love to take your interest or any questions or anything like that.
When do you think you're launching the REIT?
Very soon, in the next couple of months here.
Okay. Good stuff.
Any other questions? All right.
Thanks, Scott.
Yeah.
I think my house is in that $70 billion of houses that need updated. All right, we're going to jump right into some of our fund performance and strategy. This is also a little bit of a marketing tool, to be fully transparent, as we are currently raising our 5th fund in the Down the Line series of funds, which we'll get to in a second. Martin spoke earlier about tennis down the line. It's a tennis reason that's what's going on there. I'm not a tennis player. All right, why do we choose funds, right? And it's important for us to give you this messaging because we want you to understand why are we not just raising capital on one-off per deal basis, right? A, it's a real pain in the butt. We buy 25 deals a year. We don't want to have 50 calls each time. We love you all, but it's just not efficient, right? We want to find great real estate, move quickly, move swiftly, lock it down, right? And for us to have a bucket of capital sitting there ready for us to use it makes us better at what we do. We want to focus on just finding good real estate, right? It's also important to note that Martin and his family invest a significant portion of the fund, right? So we're not just saying, give us your money, let us do what we want. It's also Martin's money and Danny's money and the family's money, right? And not much of mine, but maybe someday. All right, so it's really about efficiency, and then the other thing is about diversification, right? So when we're buying a fund, you're getting exposure as an investor to multiple investments, right? Maybe it's 8, 10 holdings, maybe it's 15 holdings, maybe it's 20 holdings, right? So it's not a binary risk for you as an investor, right? If one of the 10 investments fails, fortunately not many of our investments are failing, but if one of it does, we're probably protected by the other 9 investments, 14 investments, 12 investments, right? So for us, we think it's a good platform. And then, it allows you all to get exposure. I think I hit on all the key points there. Really aligning capital with opportunity. It's a great tagline right there. All right, the Down the Line Fund Series. We call them DODLs, not to be confused with dawdle, DAWDLE, because we certainly don't dawdle at B&D Holdings. All right. This is the story you've been hearing all day, right? We've been growing. More capital has been committed. Another thing that happened over in Dawdle 4.5 was basically there was a large capital event for the firm, and we kind of reopened 4. So that's how we have 4.5, just to explain what's going on there. We continue to exceed prior commitments. We're currently raising our 5th fund. As Martin said, we don't go on a road show. We're not calling every high net worth person we know. I think we could probably exceed this raise, but we like to be organic. We like to do it with kind of friends of friends and friends and kind of who get to know us, and we build a nice pool of investors. So, we're excited about that. Our funds have done quite well. This is fund level IRR to investors. This is return to investors. This is all distributions to date, and also assumes a hypothetical sale of all our remaining holdings in the fund. So 4.5 are very recent, so it's very, very early stages. That's a purely hypothetical IRR, although we try to be very thoughtful and conservative with our valuations. Down the line 1 and down the line 2, those investors have already received all their capital back, plus more money, and we still own more warehouses, right? So if we may never sell those because at this point, it's kind of legacy vehicles. You might just hold those forever, continue to refinance, work rent rolls, and enhance the assets. But if we were to sell them, we've done quite well, and you'll see some vintages on the next slide. And this is to investors. This is net of any fees or promotes to the manager, to B&D. So as you see here, the vintages down the line, 2018, 2020, 2021, 22, 23, 25, it started moving a little more quickly as we started scaling the team and finding more investments. 21 and 36 over 7 and 5 years, obviously excellent returns to investors. Those are great stories of and we're going to get to a case study in the next slide about down the line too. But our target is still the 18 to 22 investors in the next fund. We will see where the market is, but we're still seeing a lot of opportunities. And again, we like these vehicles because when we have this here, we have the capital ready to pounce. I'm going to get into 2 case studies now. One is just a little bit of a story about down the line too, because it's a great story. We made 12 total investments. We sold, so we sold 8 of the investments. We've already returned capital. We had 11.1 committed, and now between distributions and return of capital, 18.3 million has been distributed. So great returns for investors. We still have 4 remaining investments that are paying our investors recurring cash flow, right? And then the other thing that's happening is, for example, we own an asset in Portsmouth, New Hampshire that we bought in, 2020, 21, and we recently rolled some leases to market, which allowed us to do a big refinance and makes a tax-free distribution to investors, right? So because we now own these and investors are already their capital back, it almost behooves everyone just to keep these and keep churning the assets. So unless they want us to sell it, and we can do that too. Anything to add, Martin? I think it's a good story.
Well, the family, this was a legacy family investment vehicle, and the family doesn't like to pay taxes. So
That's also good.
they asked me to stop selling.
Yeah, so we're not allowed to sell in Donald too, because we don't want to pay taxes. All right, I really want to highlight this because a lot of our investors know this, but we want to make sure everyone's aware. In our more recent funds, 4, 4.5, and 5, we'll use this bucket of capital to invest in a GP position with a strategic partner, right? So we'll buy deals alongside some of our institutional partners in the room. We think it's a win, right? I mean, if we raise 10, 15, 20 million, if we take 10% of the fund, 20% of the fund or whatever, and invest it alongside a partner, maybe it's $5 million, we can use that $5 million to get exposure to $200 million of real estate. And especially when you combine that with the interest of aggregation and scaling and portfolio and institutional capital coming into the space, it is healthy for us to take $20 million and get exposure to $500 million of real estate because we may now exit to the Blackstones of the world, right? As opposed to selling the one-off investment and doing well, which hopefully we would, but it's nice to now get exposure to that big capital, right? So it's not just so we can buy a lot of deals, there's some strategy to what's going on here. This is a great story. We just recapitalized this portfolio with a new institutional partner, but we aggregated 7 assets in 2022 and 23, one at a time. We identified individual assets that we liked, we thought were functional, had upside, and we bought them alongside a partner in a portfolio. The market, these were 6 of them were in the Norfolk industrial market, 1 was in Florida. The Norfolk industrial market ran a lot in rents. It had kind of been sleepy for a long time and then started to pick up. So we realized there is a lot of value that was created and there's still a lot of go forward value. So why not give our investors a win and retain, high performing assets with a new partner in our portfolio? So we just completed this about 2 or 3 weeks ago. We rolled in all of our manager equity interest back into the deal because we have high conviction in these assets, but we're also be able to get nearly double our investors' money. And this was about 25% of the down the line 4 portfolio. So for our investors, we took 25% of that and doubled your money. We're very excited to have done that. And hopefully we can keep doing this in the future. So Yes, down the line 5. We're raising. Send us all your money. That's what that means. Okay. But just I will add a few notes here. The new vehicles are not really as evergreen as the older vehicles. We are putting kind of a 9-year investment horizon on these. Obviously, there's some grayness at the end. You don't want us to sell in year 9. If the world's ending, it might behoove us to sell in year 10. But if you're looking to invest in our new vehicles, we're not trying to take your money forever. We want to kind of deploy capital over 1 or 2 years, find great investments. Maybe we can turn and redeploy if we find a big win early, but then it's year 5, 6, 7, 8, 9, opportunistically exit our investments, right? And it could happen early. I always joke that Martin just waits till someone calls him and offers him a 4.5 cap, and then he sells buildings. So that's probably what's going to happen over the next 10 years. And hopefully for us all, that's what continues to happen. So we're openly fundraising until the end of June. So you might get some marketing from us because we've kind of put that to bed for a little while. So, and then what we're going to transition to here briefly is, in addition to having the funds, which are really kind of our main investment vehicles, like we said, we want to have that bucket of discretionary capital, a lot of the family money and high net worth investors so we can move quickly. We will, throughout the year, do some one-off investments. It might be because they're larger, or it might be because it doesn't quite fit the fund strategy for various reasons, right? So we're going to talk about 4 recent larger investments we made that a lot of investors in the family and our community have separately invested in. And Martin, Danny, feel free to jump in here. So this is, we closed on this, 2024, early 2024. We acquired a 664,000 square foot chalet portfolio in the Norfolk industrial market. It was a mark-to-market opportunity. A lot of the rents were below market. It was owned by GLP and then Link Blackstone. Blackstone and Link are kind of playing a huge different game and weren't really optimizing rents and working the rent roll. Our view is that we're a local market sharpshooter and expert, and we can really get in there and work rents and work with tenants and more actively manage the assets so that we can achieve outsized returns. So we're working through the rent roll right now. This we got extremely lucky on. Some of you have heard this story, but it's a fun one to tell. So we had a structure in our purchase and sale agreement that if this 160,000 square foot lease was signed pre-close, we paid X price. If it wasn't signed, we paid a lower price. I swear to God, they signed the lease the day after we closed. We had nothing to do with this. I wish we did. I wish there was no dark arts there. We just got lucky. So we paid the lower price. We signed the lease the day after close, and that actually got us a larger loan. So we had a higher levered position. It was a very nice win for our investment. We've rolled a few tenants, and we're working the rent roll right now. The Norfolk industrial market remains super tight. We like it. There's been a little bit of slowness with indecision from lease makers from the Trump election and then now from tariffs. I think there's just some people saying, I want to wait and see. So uncertainty hasn't been our friend, but the market dynamics are still strong. There's not a lot of developable land in the area. There's still leases getting signed. So here's another one we acquired this past year in New Brunswick, sourced by Mr. Jack Schulman over there. So kudos to him. This was a really neat opportunity because we got it. We went direct to the owner. We had to, honestly, I talked to this owner with Jack like every Sunday morning for 2 months to get this deal closed. But we sourced this off. No, Bill wasn't hired to sell this because we would have never afforded it. So we bought this off market. It's a really exciting opportunity because there's Class A warehouses in the front, there's some heavy in the back, there's some heavy industrial in the front, and then there's an ugly 3-story office building in the middle of it. And I think the opportunity for us is to demolish this office building, add industrial, and then because it's northern New Jersey, we can probably achieve an institutional exit, right? So we bought this with a new capital partner who it's been great to work with, and we're just working through the feasibility, entitlement of the office demolition and new construction and working the rent roll. All is well on that investment. Here's one we recently acquired in Massachusetts. This is a great B&D investment because it's really ugly looking. And a lot of they tried to sell this to a bunch of institutional buyers in Boston, but the building has like big red letters from the 80s of the former tenant's name, and it's metal and it's not painted and it's really bizarre looking. And it even has a museum for old cars in the back. So it's just like everything weird about it, but it's highly functional real estate. The average suite size is probably 30,000 square feet. So everything we spoke about earlier about sub 50,000 square foot leasable spaces, this has what it offers. It also combined, in the bottom part there, that is a 1 acre fully paved outside storage lot. I don't know what's happening in this aerial, but it looks nice and clean now. And the beauty of this as well is this is an iOS asset, but it's not less than 20% lot coverage. There's a lot of like industrial outdoor storage investors who only want to invest when the lot coverage is lower. But here you get the best of both worlds. So if you're willing to, then you don't have to compete with the Alteras, the Zeniths, the Blackstones, or whatever we were discussing earlier for this asset. And you're not necessarily competing with the shallow bay institutional buyers of Boston, but it's a super functional asset that we pounced on. I wanted to say this today, so I'm going to say it now. We always joke like, who's the iOS police? You know, everyone in the room has heard me say this on separate calls, but we love that the iOS police don't know what this is yet, and they're not. So we call it iOS. Yeah, and we're just we've done some capital improvements. We're working through the rent roll. We're excited. I added a note that the iOS tenant wants to stay in the lot. They've already approached us. We're not executing any new leases yet because we're potentially allowing any of the new building tenants to use that space, which may allow us to drive rent. And we're doing this across our portfolio. In Virginia, we have 3 acres a yard. We had a tenant who wanted to lease half of it for 10 years, but the building is rolling in a year. We didn't necessarily want to tie up the yard because you might want that tenant who can get that unicorn asset of having a building and yard. So we try to be thoughtful there. And this is the story that Martin told earlier, and we love this story because this is what B&D does best and how we beat our competitors. This was on market, a little expensive, and then kind of sat there for a little bit. A tenant, one of our large tenants, approached Danny and said, hey, will you buy this asset? I want to take 40,000 square feet and that yard area that you're seeing, and we'll sign a long-term lease. So we said, sure, we'll do that. The metrics looked great. We tied it up. Jack knew the brokers. Jack entered to help lock down the deal. As Martin said, and he actually knew this was going to happen from the start, and it happened, which is classic Martin. He's like, they're never going to afford this rent. So they couldn't, because $1 million a year total occupancy cost, right, to occupy the space. In the 40,000 square foot building was GM, obviously a large national established credit tenant. They have like a training school where they're training techs how to fix electric vehicles, and they fly people from all over the country to use. And they have all these individual bays where they're working on cars. And I mean, obviously our base case was like GM's not going to leave, but they hadn't signed a renewal yet. So the minute we started walking through the building, they said, what are you doing? We said, don't worry, see you later. We got a new tenant. And they said, yeah, I don't think so. So Danny worked successfully with the seller and GM to, before close, get a relatively long-term lease done with GM at a top market rent. And that's, again, there aren't shallow bay assets like this. They have nowhere else to go. We had total landlord pricing power on this. Then we separately took the yard, I don't even know if it went to market. We hired a leasing broker. They might have swindled us. They already had the tenant, but we put it to market, and then we had a national iOS tenant come in playing top market rent. It's out for signature, so I won't get excited yet, but we think we'll have a lease signed for the yard in the next 2 weeks. At that point, we're in Westchester, right? We're just north of New York City. We'll be north of an 8% yield. We think there's a huge opportunity to sell this to a core plus institutional type buyer. So if anyone wants to buy it, let us know. So yeah, it's an exciting deal. It's nice how it marries a lot of parts of B&D Holdings into one transaction. So, oh, Martin, this is you. This is you. You got to tell the story, all right? So we just have another slide or two here to talk about looking forward, and then we'll take a few questions if anyone has any. And I've heard that the YouTube questions might not work from a few texts, so maybe that's why they're not there. It's not because they're not interested. It's not. All right.
Thank you, Rob.
You're welcome.
This is working? Okay. So looking forward, I kind of talked a lot about us, positioning the team and our infrastructure to take advantage of the existing and coming consolidation and institutionalization of the iOS and shallow bay space. And, we're looking to continue that. And this was kind of already covered a lot. We're in a niche growing sector, and we have capital committed, we have funds, we have family worth, we have great institutional partners, and those are things that give us flexibility and kind of separate us. I mean, the other large players have that, but there's a lot of smaller players. As the space matures, it might be harder for the smaller, less integrated folks to raise capital, and that could broaden kind of our capabilities. We like to approach the acquisition market from as many different angles, which is many different nuances, tenant sourcing, relationships, as possible. We really value our reputation, which I think will help separate us. We're beginning to hear it. We're looking at, different properties right now, and our construction guy Wyatt, who's done, tons of build outs. He's having a problem getting pricing from contractors because he said, well, all these industrial properties are getting locked up, and the people don't know what it costs. So I'm not even going to bid the product. I'm not even going to bid the project because it's not going to happen. It's going to be way more than the sponsor thinks, and it's going to be a waste of time. And then Wyatt says, well, we did this 20 times in the last year. Here's what our concerns are on the project. And the guy's like, all right, you guys know what you're doing. We're not going to spend our time there. We'll. And the same thing's happening with brokers, with our competition. Maybe somebody's going to offer more. Some of these assets are old. Having somebody with a track record, that knows it, kind of separates us. Okay, you can get 10 million. There's a lot of deferred maintenance. We're at 9.3, but hey, we know it's a new sprinkler. We know it's this. We know it's that. We get a certainty of execution that we can provide, and it all comes down to executing the business plans, like the Ardsley deal. Hopefully we're at 20 million. Hopefully we go to market at 30. I don't even know, but in a 1 year hold. We want to make that happen more times, every year. So I'm excited for where the industry came from my father's day, where it was, we're buying a building and we're getting the land for free. And I was thinking maybe one day we can develop that into larger buildings, to now everyone's paying for iOS. And now institutions are continually getting involved. And that's why we're focusing so much on our systems, our team. We want to be a player there. And we think we have a special niche, and we approach things in a way that will provide outsized returns in the future. And, to keep growing, we want to keep what we're doing. And, I want to pick up some larger portfolios. And that's what we're gearing up for. As more competition comes in and more capital is deployed, cap rates should come down. And that's good for our existing portfolio, but we have to get more creative on the deals that we're finding. And I think with this, like other parts of real estate that are operationally intensive, I think the operator and our capabilities are going to be differentiators. These are smaller deals. It's very hard for larger investors to keep track of everything that's going on. You kind of need an operator with a track record and the team in place that understands the markets. So we think demand for our services will increase, and our goal as more capital is going into the space is to grow as reasonably quickly as possible, doing deals that we think make sense, generating more deals, and executing them. Because we think the portfolio, the scale, and the amount of properties and the tenant relationships has a lot of value. It leads to working with more like-minded, better brokers, like-minded tenants. Danny just sends an email out on a vacancy coming up, and a tenant in our portfolio responds to it. We've already done 5 leases with them. They know they don't have to negotiate another lease. They know how we're going to approach it. These real estate real estate officers are very busy. It saves them time. It checks a box. And the larger you are, the more you can kind of you can kind of take advantage of scale. So we're excited to grow, and we're excited for the challenges that more competition brings, and the opportunities. And I think by building a first class business, it'll lead to better investment results. When we're buying every investment, we're underwriting it to what that individual property would sell for. And that's our exit cap rate. The reality is, if we sell as a portfolio, or if we continue to aggregate, there's a large premium in today's market, over and above what we're underwriting. So, if we execute a business plan and we say we're going to sell at a 6.5 cap, and you're going to get 22% returns, we might sell at a significantly lower cap rate than that, due to the scale. And the more we can kind of build and grow, the more value we can create there. So that's kind of our story and what we're doing. Thank you guys for the support. The last couple of years, it's been great to work with everybody. And thanks for the team for putting this all together, and working hard throughout the year so I can go fishing and do my philanthropic stuff. Does anyone have any questions? And if you guys have questions on individual investments, especially the older ones that we might not report on as much because we did a 10-year lease with ABC and nothing changes. Always reach out to me and Rob or anyone on the team. I'm happy to jump on a call and go over any questions. I know we have a lot of investments, so sometimes it's easier just to talk about it. We do try to keep as up to date with our high net worth reporting as possible, but sometimes it's tricky and there's a lot of moving parts. And then we make whenever we have good news, we forget to tell everyone, which we should get better at. And we just send a check. We'll work on that.
Questions? No? No? Okay. All right, cool.
Any questions from YouTube?
No, I think we blocked them accidentally. We're good? All right. Thanks, everybody. We appreciate it.
Okay. We did it. Good.
Much less stressful.